Your phone screen cracks. You're suddenly glad you paid that monthly insurance fee. But have you ever wondered who's actually winning in this arrangement? That monthly payment feels like a gamble. You pay hoping you'll never need it, but the company counts on most people not making claims. That fee you pay every month is called a premium. It's how insurance companies pool risk across thousands of customers. When enough people pay premiums, the pool of money grows. That pool is what pays out when someone has a claim. You see the recurring payment date every month. Ever wonder how the company can afford to pay out big claims when you need it? All those premiums add up to a huge pool of money. That's what they use to cover claims. Insurance companies use math to set premiums above expected losses. That's how they stay solvent, even if claims spike. They price premiums higher than what they expect to pay out. That margin keeps the business running. Think about a coffee shop full of people with cracked phones. The insurer spreads that risk across thousands of customers. Pooling all those small risks reduces the uncertainty for the company. That's the core of how insurance works. Underwriting is how insurers assess your individual risk factors to set your premium level. Your age, location, and claim history all affect your premium. Higher risk means higher payments. How does the company make extra money beyond just covering claims? Where does the profit really come from? They invest the float, the premiums they collect before paying out claims. That investment income is a huge profit source. Insurance companies profit from two main sources: underwriting margin and investment returns. They collect premiums, pay claims, and invest the float in the meantime. The profit comes from the difference between premiums collected and claims paid, plus the investment gains. That's the full mechanism. Simple math, not magic. Insurance pools risk across many people. For 100 customers, premiums collected cover payouts, and the company makes money by investing the float. Spreading risk reduces individual uncertainty. That's how they profit beyond just covering your phone, by sharing the burden across thousands. Actuaries assess your risk factors, phone model, location, usage, to calculate your personalized premium. That's why your price differs from others. They clarify the pricing by weighing each factor. Higher risk means higher premium. Simple math that keeps the system balanced. The company's investment portfolio grows while waiting to pay claims. That's the float, money from premiums that earns returns over time. Where does the extra money come from? Investment returns on the float boost profits beyond just underwriting gains. If claims exceed premiums, the loss ratio goes over 100%. That means the company pays out more than it collects. Unsustainable. What happens if too many people claim? The company becomes insolvent. Can't pay out, goes bankrupt. That's why they monitor this closely. The 1906 San Francisco earthquake shows how insurers handle massive, simultaneous claims. They prepare for catastrophes with reinsurance and reserves. How do they handle disasters? By spreading risk globally and having catastrophe bonds, so one event doesn't sink the whole company. Your $10,000 premium splits into $7,000 expected payout, $500 risk premium, and $2,500 overhead. That's the fee allocation. How is my premium split? The company covers expected losses, charges a risk fee, and pays for operations, demystifying the fee structure. Insurance Bro shows the combined ratio metric that determines company profitability. When loss ratio plus expense ratio stays below 100%, the insurance company actually profits. Insurance Bro uses a coin flip game to show how insuring many people reduces risk variance. One person might lose, but 1,000 flips even out. That's how insurance companies stay profitable. Insurance Bro reveals that premiums get invested while waiting to pay your claims. That investment income becomes a second profit stream beyond just collecting more than payouts. Insurance Bro explains the float, premium money sitting idle until claims come due. They invest this float in bonds and blue chip stocks to generate returns before paying claims. Insurance Bro walks through underwriting, showing how age and driving records set your premium. Each risk factor gets assessed individually to determine what you pay for coverage. Insurance Bro shows actuarial tables that predict future claims using probability math. Actuaries use statistical models to price premiums based on loss probability calculations. Insurance Bro breaks down the two profit sources: underwriting gains and investment returns. Premiums minus claims plus investment income on the float. That's how companies stay profitable. Here's where insurance gets tricky. When you're covered, you take bigger risks. That's moral hazard in action. People drive worse with collision coverage. File more claims. Companies have to control for this somehow. Deductibles solve this. You pay the first chunk yourself, so you stop before taking stupid risks. Policy limits cap maximum payouts. Both sides win. Lower premiums for you. Controlled losses for companies. So insurance companies profit. Big deal. They're also there when your phone screen shatters. They make money. You get protection. Both sides need each other, and that's actually fine. Your premiums don't sit in a vault. Companies invest them in bonds, stocks, assets, while waiting for claims. That investment income is a second revenue stream. Additional profit on top of collecting more than they pay out. They collect premiums now, but pay claims later. That gap? That's the float. They collect early, pay late. Months or years of investment growth before they write a single check. That's the timing advantage. One person facing disaster is unpredictable. Insure 100 people and the math gets stable. Risk pools smooth out uncertainty. The company knows roughly how many claims will happen. It's predictable at scale. That's the statistical advantage. Your premium isn't random. Age, driving record, lifestyle choices. They assess your individual risk and price accordingly. That assessment feeds the pool. Your risk profile gets mixed with thousands of others, and the math still works. When the combined ratio is below 100%, the company makes underwriting profit. When it's above, they lose money. Premiums collected beat claims paid, so the company keeps the difference as profit. Underwriting profit, investment income, and economies of scale all feed into the company's bottom line. That's how the profit actually comes from multiple streams, not just claims. The repair cost was $200, but the insurance paid $150, so dude saves money. The company spreads his risk across thousands, keeping the cost predictable. Insurance is math and risk pooling, not magic. Both he and the company benefit from the arrangement. They look at age, health, driving record to estimate claim chance. That premium covers expected costs plus a safety margin. Hundreds of people contribute premiums, spreading the loss risk. The total loss becomes predictable when many policies share it. A premium breaks into expected payout, risk margin, and overhead costs. That's where the leftover money goes after claims are paid. Insurance companies profit from float. That's the money you pay monthly, but they hold before paying claims. They invest this float in safe assets like bonds, earning extra revenue while waiting to pay out. This investment income is why they can profit even after paying claims. The float isn't magic. It's just math and timing. The combined ratio shows if they're making underwriting profit. Under 100% means they're winning before investments. When loss ratio exceeds 100%, claims exceed premiums. But investment income keeps them solvent most years. Like coin flips, individual claims are random. But when you pool thousands, big simultaneous losses become statistically unlikely. That's why insurers stay solvent. Massive losses for everyone at once are extremely rare. You get financial protection and peace of mind. They profit from margins and investment returns. It's a math-driven exchange where both sides benefit from probability and careful management. Insurance works through risk pooling, float investment, and statistical ratios, not magic or mystery. It's probability and math working together to create a system that protects while generating profit. Hunger's paradox, the tension between craving and constraint, shown through repetitive meal choices. The ritual becomes a symbol of unfulfilled desire masked by discipline. Habitual behavior creates emotional stagnation, the same choice despite growing dissatisfaction. The isolation becomes palpable, routine masking deeper emotional conflict. Every character faces this conflict. You crave the forbidden thing, and that craving contrasts with every rule you set. Insurance companies exploit that tension. The desire feels personal, but companies study conflicting needs and build entire products around your inability to resist security when fear kicks in. The screen casts a harsh light on a missed payment. The character feels anxiety stacking up, and every insurance company already knew this would happen. They build the system expecting misses. Conflict is the product, and companies profit from the gap between intention and follow-through. You expect a reminder to arrive, but the screen stays empty. Anticipation dims into something worse than the bad news you were ready for. The character doesn't get the second chance. Insurance companies don't send reminders out of kindness. They send them because empty screens cost them money. The character accidentally spends on the exact item they were trying to avoid. One critical error, and every effort to recover starts falling apart. This is the mistake insurance companies highlight in their marketing. The error isn't buying the snack. It's trusting yourself to always course correct. The character tries to cancel amid the chaos, but the app flickers and fails. Every attempt to fix the device just deepens the frustration. Insurance companies design systems that are hard to cancel on purpose. The failure isn't a bug. It's a business model built on your inertia. The character collapses onto the couch, surrounded by empty containers. This is where every conflict concludes, not with answers, but with sheer exhaustion. Insurance companies know this feeling well. They profit from the cycle of hope and collapse, because you'll always come back needing protection.